Hello, I'm Dr. Cheryl Dunn, and I'm here to demonstrate an introductory financial accounting problem in which we're calculating the accounts receivable turnover and the days sales and receivable ratios for a company called Pretzel Rod, Inc. So take a look at the problem. Okay, the receivables turnover measures how many times a year the company is able to collect its entire accounts receivable balance, or the dollar value equivalent of its entire receivables balance. It's calculated as the net credit sales divided by the average accounts receivable. Because this ratio is comparing an income statement number to a balance sheet number, we have to average the balance sheet number to make the time periods more equivalent. Because recall that an income statement number covers a period of time. It has a beginning and an ending date, and it encompasses the activity between those dates. A balance sheet number is at a point in time. Now, it's not a perfect equivalent to take the beginning balance plus the ending balance and average it together, but it's at least better than only using one of the 2 points. And so every ratio that we use in introductory financial accounting that compares an income statement number to a balance sheet number will average the balance sheet number. Okay, so average accounts receivable then is going to be the beginning balance plus the ending balance, and then divide that by 2. In this case, our beginning balance in accounts receivable is $130,000, and the ending balance is $150,000. When we divide that by 2, we end up with $140,000 as our average accounts receivable. The net sales for the company is given to us as $1.4 million. We then divide that by the average accounts receivable of $140,000, and that gives us an accounts receivable turnover ratio of 10 times. So approximately 10 times a year this company collects the entire balance of accounts receivable. We then use this number to calculate the days sales and receivables ratio. The calculation, or the formula for that, is 360 if we're doing it for a year, divided by the receivables turnover ratio. In this case then, it's 360 divided by 10, which equals 36 days. So on average it takes about 36 days to collect a customer's accounts receivable. This is a number we can then compare to the company's collection policy. And if they're supposed to be collecting their accounts in 30 days, 36 days is a little bit over that. The management would have to determine whether that was within a tolerable range or not. If their credit policy was something like net 15, we would say they're doing a really bad job, because if they're supposed to be collecting their accounts receivable within 15 days, they're more than double that. On the other hand, if their credit policy was net 60, they're doing a great job because instead of taking 60 days to collect their receivables, they're collecting them in 36 days. Thank you for viewing this demonstration, and I hope you found it helpful.